So learning objective 2, this is the heavy lift in this chapter. Every chapter kind of has, excuse me, a section where there's a bit more work to do than other sections. This is the one. And the reason is we're going to learn about how businesses cost out their inventory. Now remember, when you go into a store and you buy something, they are going to record the revenue, clearly from selling that to you. But the first expense they subtract out, as you know from the income statement, is cost of goods sold. The problem is they're buying inventory all year long. They have beginning inventory in the store, they're purchasing more inventory. So all those goods are available for sale. A customer comes in and buys something. What did it cost them? What did it cost them? So there's methods that they can use to determine the cost flow that they want. And that's what we're going to be talking about in this section. So basically, remember, when they buy inventory, it's recorded at its cost, right? What it actually cost the business to purchase that inventory. So when they sell the inventory to the customer, they also have to use a cost, right, for a cost of goods sold. But again, they're buying inventory at different periods of time throughout the year. And as you know, prices change. So, my little Pooh doll, might have cost Disney in the first batch, they might have paid 50 cents for each Pooh. But then they went and got more batches of Poohs made, and that might have cost 75 cents. Might have cost $1, what have you. I don't know what my sister-in-law paid for this, but I'm assuming it's probably a good $4 or $5 for it. And so when they recorded the sale of this, what did they cost out? The Pooh that cost them 50 cents or the Pooh that cost them $1? You really can't tell them apart. They look the same. So that's what this cost flow methods are here to answer. Companies have choices on how they want to cost out the inventory. Okay. The most common ones that we are going to focus on are the ones listed below here. Okay. These are the ones that we're going to focus on. First in, first out is also called FIFO. Means the first one, I'll go back to my Poohs here. The first Poohs that have come into the store are the first Poohs they are going to cost out as cost of goods sold. So they look at their inventory list and they figure out which ones were in first. Those are the ones we sold first. And that's how they use it. We're going to learn about that today. Another system that a retailer can use, and again, it's totally their choice as to which ones they want to use, is something called last in, first out, or the LIFO system. And again, I'll go back to my little Winnie the Pooh here to say that they'll look at that list of inventory. They had Poohs at the very beginning. They bought more Poohs to put in the store as the year went on, and I bought a Pooh. So if they used LIFO, it's the very last Pooh that went into the store, whatever that cost them, is going to be the first Pooh that they cost out. Okay, and you're going to see that play out here. And then the third system that they can use is something called average cost, which basically means that they spent a ton of money buying all these little Pooh dolls. They simply average the cost. So each Pooh might have averaged, say, 75 cents. And so regardless how many they bought that year. And so that's the average cost of the Pooh, and that's what they're going to subtract out as their cost of goods sold. What we're not going to go into is another specific type of method called specific identification. It's listed there. It is a cost flow method. It's legit. It just has to, it's only used really with very unique products when you can identify the specific cost of everything that's used. And so it's extremely, it's not widely used. And again, if you work for something very unique, someone who builds very unique homes, very unique automobiles or luxury yachts. I mean, I'm talking real unique, you know, then that company might be using specific ID. But you and I, in the form of retail, they're not using it. So we're going to stick with these other three. Okay. So we're going to just skip right over the specific ID slides because we're not going to need to know that. What we are going to need to know are those cost flow assumptions that I mentioned. As you see, the clear winner here in terms of which companies actually use what cost flow method, FIFO is the big winner, first in, first out. Most companies use a FIFO system to cost out their goods as they sell them. And so we're going to learn that first. A second place showing is for LIFO, okay, last in, first out. And then, of course, average cost is in third, and then you have the other one that we just talked about is in fourth place. So basically speaking, we'll move on. Let's take a look at how these methods work. Everything starts with a list of inventory. If you do not have a list of inventory in front of you, you can't do any of these methods. So make sure you know step one is you need the list. Okay, you need the list of inventory. So here your book shows this company, Houston Electronics, and their product, Astro condensers. I think it's sort of a play on words, but it is what it is. And as you see, you kind of know how it goes. They start the year with a beginning amount of these products in their inventory. They have 100 of these Astro condensers right away as of January the 1st from the previous year, right? The cost for those Astro condensers to the company were $10. So they're starting the year off with beginning inventory of $1,000. Right? 100 units are still in the store at $10 each. So that's $1,000 of inventory that they start with, which is this number here, beginning inventory. Notice that through the year, they made some purchases. They bought more Astro condensers in April, more yet again in August, more yet again in November. Okay. And every time they went to buy these Astro condensers, they bought a little bit more. 200 of these units were purchased in April, 300 were purchased in August, 400 were purchased in November. And one thing that's also interesting is every time they purchased these, their cost, they had to shell out more money for each one. So when they purchased 200 in April, they actually had to pay $11 each for those Astro condensers. When they bought them again in August, they actually had to pay $12 each for each of those Astro condensers. Okay, the totals are listed on the side here. And of course, the 400 they bought in November yet cost them more, $13 each. So they ended up forking out a lot more. So all of this really indicates that they went ahead and purchased another $11,000 worth of Astro condensers. So their beginning inventory was $1,000. That's this number here. Their purchases were another 11,000. So the total amount of inventory they had for sale was $12,000 worth of inventory. Okay. So this actually follows what you learned in Chapter 5, Objective 5, where you're kind of sort of following that chart. You can also do this chart with units. They started with 100 units in beginning inventory. They bought another 900 units in purchases. They have a total of 1,000 units for sale. Okay. So you can do this for cost. You can also follow this for inventory, and that's important to know. Well, we subtract out the ending inventory. Well, we don't know the cost of that because we have to determine it, but we do know that they have 450 of these astro condensers still in the store at the end of that fiscal period or accounting period, which means they actually sold 550 of these 1,000. Well, what our trick is here is to figure out how much of this $12,000 of inventory is still in the store and how much of this $12,000 inventory was actually sold. And that'll give us the actual dollar amounts for ending inventory and cost of goods sold that we can finish out our things. And this is where the methods play into it. The methods help us determine what's the cost of ending inventory. What's the cost of goods sold? The methods allow us to do that, and that's what you're going to learn. So the first method, FIFO. And of all those times you heard of Jack and the Beanstalk, when he went up there and he was in that castle and he heard that giant, he was actually an accountant. Fee, fi, fo. Where's that inventory? No. I thought it was good enough to say it, so I did. But anyway, you know, swing and a miss for some, home run for another. All right. So the FIFO method says, look, we're going to look at that inventory list, and the earliest goods on that list, we're going to cost those out first. That's going to be our cost of goods sold first. Okay. And so it basically parallels the physical flow of the merchandise that you see on that list. Okay. Which means that the ones that are very early on the list have been sold. And the ones at the very bottom of the list are still in the store. And you'll see that play out right here. So this is a very, very good illustration. It's also in your book, and it's certainly on Wiley to follow regarding FIFO. Again, you cannot do anything without an inventory list. So you have to look at the inventory list for this to make any sense. Okay. The first ones in are the ones that started with January. Those are the first ones in because they're the first ones on the list, right? And so those first ones in have already been sold. That's basically what this is saying. Okay. So, which means that what's your ending inventory? Well, your ending inventory are the ones toward the bottom of the list. So if you have 450 units of that 1,000 still in the store, well, you've already sold this, you've already sold this, you've sold most of those. So you have these 400 in the store, plus you got 50 of those in the store. And that's what the inventory shows. You got 400 units from the very last purchase that you made, plus 50 of the ones from August are still in the store. The 400 units from November cost you $13 each. So that means that $5,200 of that inventory is still with you. And 50 that are left over here are at $12 is $600. So you have literally $5,800 worth of astro condensers still in the store, which means if you started with $12,000 of astro condensers and you still have $5,800 of them with you, you sold the rest. And thus, that's how they calculate the difference between the total cost and what you still have in ending inventory. The difference will give you your cost of goods sold. But of course, you know, in math, you can prove this number. How do we prove that $6,200 is correct? Well, we simply can prove it by going over the ones that have been sold. These 100 have been sold, which means all this $1,000 is part of that. These 200 have been sold, right? Because you sold 550 of them. So these 100 are gone. These 200 are gone. So that means this 2,200 is part of that. You have 300 sold of 550. So you sold 250 of those have been sold. 50 are still with you. So 250 at $12 will give you the three. So $1,000 plus $2,200 plus $3,000 is $6,200. So you can prove it either way. Your book shows you do the ending inventory first, and the rest is cost of goods sold. But you can prove both numbers, right? You can prove both numbers that way. All right. So this is really critical, going to be a critical part of your homework. Again, you cannot do any method, and we're starting with FIFO, without the inventory list in front of you. This is the key. You're reading this inventory list. Okay. That's how we cost things out. And this is a very beautiful illustration, as you see. It is in your book. It's on Wiley. It shows, this is your beginning inventory. Here's your April, August, and November purchases in total. And as you see, they're showing that all of this part, right, the first ones in have been sold. So they're on a truck being delivered to, I don't know, who buys Astro condensers, but anyway, they're going to that group of folks. The rest of these are still with you in ending inventory. This is actually quite a beautiful illustration, and I actually have this particular picture in my hallway. Okay, it's crazy. It's called accounting art. It's really crazy shit. Good stuff. But I'm hoping that might make me be worth $1 million in the future. Okay. There we go. The next, this is the second way of looking at things, the LIFO method, last in, first out. Although accountants will tell their kids often, would you please get a LIFO? And that means that we're looking at this list of inventory, and the last ones on that list, we are going to cost out. We're going to say these are the ones that we sold. And so it's simply the opposite of what LIFO looks at it, right? What FIFO look at. LIFO is sort of the opposite, okay? And so we, again, none of this is going to make any sense without an inventory list in front of you. So when you look at this inventory list, what you see is the last ones in were from November 27th. They're the last ones on the list. So they're the last ones in. Excuse me. And here what we're saying is the last ones in are the first ones that we sold, right? And if you remember, we sold 550 of them. So all of these have been sold, and half of these have been sold, right? The rest are still in the store. So the first step your book shows you is, well, what's still in the store? Well, 450 are in the store. Which 450 are in the store? Well, the beginning inventory is still in the store. The April Astro condensers are still in the store. And half of the August inventory is still in the store. These are the costs for each. 1,000, 2,200, and half of that is 18. So you have $5,000 worth of inventory still in the store. Again, you had $12,000 of Astro condensers this year. At the end of the year, you have 5,000 of them left, $5,000 worth of inventory left. You sold the rest. That's how it's done, right? Again, can we prove this? We can prove the cost of goods sold by doing the opposite. Which ones did we sell? We sold these 400 because they're the last ones in. They're the first ones out. So these 400 have been sold, and half of this has been sold. So 5,200 plus 1,800, that's half of that, is 7,000. So we can actually calculate and prove both ways. But again, last in, first out starts just like the FIFO method with the inventory in front of you. You have to look at the inventory list for this to make sense. And this is another beautiful illustration. Again, part of my huge accounting art collection. And it shows, again, here's your beginning inventory, your April purchases, your August purchases, your November purchases. Again, the last ones that were in the store, right, which are those bottom ones on the list of inventory, have been costed out. The ones that are on the top of the list are still in the store. They're still part of your inventory. Okay. I think everyone's going to love average cost because it's simply the weighted average of everything. Right? Very, very, a lot of people love average cost because it's relatively simple. Again, average cost also starts with that big list of inventory. But average cost looks at two things. How much money did you spend on astro condensers? And how many units of astro condensers did that buy you? So if you spent $12,000 of astro condensers and it bought you 1,000 units, each unit had an average cost of $12 each. So that means $12 becomes the cost that we use for both cost of goods sold and ending inventory. Okay. So again, here, ending inventory, we have 450 of these things still left. They're $12 each. $5,400 of ending inventory is still in the store. Again, $12,000 is where you started. 5,400 is where you end. The difference is what you sold, 6,600 cost of goods sold. How do you prove that? Well, you prove it the same way. You sold 550 and they're worth $12 each. So that's going to give you $6,600. This beautiful portrait is actually in my bedroom, because I just think it's an average. You gotta love it. So again, $12 per unit. That's the cost per unit, and then we know the number of units. We have 450 of those still in ending inventory. We sold 550 of them as cost of goods sold. And look at, this is important to note why we're breaking this down, right? Ending inventory. Inventory is an asset, belongs on the balance sheet. Cost of goods sold is an expense, belongs on the income statement. It's important that we make sure this is correct, particularly if we're a merchandising company, because this is all we do. This is all we do. So we have to make sure that is accurate as possible. Does it really matter which one we use? Well, yes, it can affect profitability of a company. If you look at the financial statements for Houston, if they use LIFO, if they use FIFO, or if they use average cost, you'll see a couple of things. Their ending inventory is going to be a little bit different. Their cost of goods sold is going to be different. And of course, that's going to affect their gross profit. And if it affects their gross profit, it's going to affect their net profit, their net income. So here with higher gross profit, you have higher net income. With lower gross profit, you have lower net income. What should Houston Electronics do? They have a choice of which method to use. I would advise them to use the FIFO method because it does two things. It gives them a larger gross profit margin, right? And it also gives them a larger net profit margin. So that's, of course, what stockholders want to see, how profitable your company is. And a $2,300 profit to a stockholder is much better than a $1,700 profit. So that's what they're going to do. And the ratios would also be much higher if they use the FIFO method. So this particular company would use the FIFO method. Well, then who in the world would want to use the LIFO method? Well, I will tell you who in the world would use one. There are some companies that the newest stuff they buy is actually cheaper than the first time they bought it. So when you think about products that go down in price over time naturally, you basically would start with your technology. So your computers, your laptops, your phones. When they first come out, they are at their peak. They are most expensive. And so your costs are going to be high because your prices are going to be high. However, over time, as the months go on, as the years go on, those costs come way down, right? Because they're no longer the talk of the town, they're no longer top notch, and so, but people are still buying them. I myself, I have an iPhone SE. There's nothing wrong with them. I don't have to have an 11 or a 12. So they still sell these products, but they're obviously much, much cheaper. So in that sense, like a electronics retail giant like Best Buy might want to use a LIFO system because it will produce for them a higher gross profit and a higher net income. But again, every company has their choice. Definitely has their choice. Okay. All right. So the do it exercise here for learning objective 2 simply gives you an idea now that you know about those methods. Can you actually practice them? Right. So they give you a simple one, the accounting records of Shumway AG. So it's an agricultural company. And they give you some pieces of information here, and they ask you to determine the cost of goods sold. They can ask you to do two things. They can ask you to determine the cost of goods sold, or they can ask you to determine the inventory value, the ending inventory value. Those are the two things that they can ask about. So you know how it goes, and you're thinking, looking at this, there's got to be some way of figuring this out, and there is. You have your beginning inventory and your purchases. This is what you're looking at. Your beginning inventory of 4,000 units at $3, and your purchases of 6,000 units for $4. These two together give you your total available for sale. Right. So you have 10,000 units available for sale. How much did you sell? You sold 7,000. So of these 10,000, which is the total available, you sold 7,000 of those. Okay. Now we're not calculating revenue, so we don't really care what price we sold it at. We're assuming it's going to be a much higher price. What we're caring about here is the cost. So we have to focus on what numbers we're looking at. And the numbers we're looking at are the costs here. Okay, so what is the cost of goods sold of these 7,000 units? Well, it depends on the system you use, right? If you use FIFO, which 7,000 units were sold? Well, FIFO starts at the top and goes down. So the first ones on the list, these 4,000, were sold as part of that 7,000. But you also needed 3,000 of these units to make the 7,000. So you had 4,000 sold at 3, 3,000 sold at 4. So your total amount of cost is $24,000 for this particular company using the FIFO method. Again, first one's in, those 4,000 were in first, so they're part of their cost. They went out first. 4,000 is 3,000 short of where you need to be, so you need another 3,000. However, this purchase was $4 each. Just so happens that it all equals out here. What if they decided to use the LIFO system? All right. Well, again, it's the same, right? Beginning inventory plus all your purchases, there's your available amount for sale. You had 10,000 for sale, you sold 7,000. Okay. So under LIFO, which 7,000 did you sell? Well, LIFO looks at things from the last ones in up. So of those 7,000 units that were sold, you sold all of the 6,000. And you needed 1,000 more. And so what your solution here is $27,000 is the total cost of goods sold for the sale, because LIFO takes the last ones in are the first ones out. So you have 6,000 of the 7,000 accounted for. You need 1,000 more to get the 7,000 all accounted for. And then you simply add them up. And the last thing would be your average cost. So to get an average cost, you need to find out two things. How much did it totally cost you to buy these 10,000 units? Well, it cost $36,000. 4,000 at 3 is 12 grand. 6,000 units at 4 is 24 grand. 12 and 24, 36. So you spent $36,000 and that got you 10,000 units. So the average cost of each unit is 36,000 divided by the 10,000, which will give you $3.60 per unit. You sold 7,000 of them. So 7,000 times 360 will give you your cost of goods sold. Your book shows you how to do it the way they teach you. The total amount of inventory minus the ending inventory gives you the cost of goods sold. So here they have 36,000, which is the total amount. They subtract out the ending inventory. Well, 3,000 units are the ending inventory at 360 each, because everything's worth 360 each. You subtract that out, you get 25,200. You can also get 25,200 by taking 7,000 and multiplying by 360. Okay. So this is the fun that's coming up. Woohoo! But as interesting as it looks, it's actually quite interesting. And once you get the hang of it, it's not going to be a huge issue. Not going to be a huge issue.